Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stocks cutting into gains of more than 17% for this year. Michael Purves of Tallbacken Capital Advisors writing, the biggest threat to the S&P next year is the AI spend will be considered not to generate compelling returns. This means multiple contraction for a key part of the market. Michael joins us now. Michael, thank you so much for being with us. Happy New Year to you. Let's start with this idea of how much AI has really upheld the rally so far this year. Can you take a look back and give us a sense of how dominant that theme was and how that might be poised to shift in 2026?
Well, Lisa, if you look at the sort of large tech relative to cyclical and value pair over the last, not year, but the last 6 or 7 years, that line goes up to the right just like the overall market does. It's sort of one and the same. And what I've argued for years now is that the big tech rally is kind of the broader SPX rally. There's just consistent outperformance in almost every year, except when you have bear markets like 2022. And even then, it wasn't really that ferociously sold off. There's very good reasons for that, which is that they generate not only a superior quantity of earnings, but the quality, meaning the volatility of those earnings, is remarkably low. And so compared to cyclical and value earning streams, they're just a lot more superior. What I'm really, the question I think that I have as we look into 2026 is that you have these giant companies, you have, Microsoft, Meta, Amazon, and so forth. All of them have very distinct business models. And many of these companies are really now converging in a very massive way on this AI spend, which is they're taking their business models from a very distinct place almost to a somewhat similar place in some respects, right? We're talking about $1 trillion of cash out of 4 companies over the next 24 months here. So just to finish the thought, Lisa, I think that the question that I'm really asking is that if the return on invested capital is not there, and if you look at the free cash flow yields on stocks like Microsoft, they're at record lows right now. So the price earnings and earnings growth ratios look very compelling. The free cash flow is the problem, and so it all works if the returns are there. But if it's not, you're going to see a real re-rate in the big tech pillar of the market.
Is there a signal that you're getting, Michael, just to sort of build on this idea from the race of some of the acquisitions that we've seen to close out the year, whether it's NVIDIA with Grok, whether it's what we saw with Meta and that Singapore-based company having to do with AI, whether it's what we see right now with NVIDIA potentially acquiring an Israeli-based tech company? I mean, they're using their free cash flow to do something. What's the signal for how much this is a shift in narrative going into 2026?
Well, yeah, I mean, I think it does remind me of a little bit of 1998, 1999, 2000, when telecom and tech were converging and frantically, there was frantic deal activity and frantic capex activity as well there. And of course, there were some ultimately great winners and there was a lot of write-offs as well. I don't think, like we talk about FOMO in the stock market, and I think there's FOMO in the C-suite here too, which is that all these giant companies are frantically trying to position themselves, for the long haul here. And in that process, you're going to see a lot of narrative rewrites going on and a lot of people speculating as to who the winners and losers ultimately are. I go back to, 3 years ago when Google had that all hands on deck meeting because they were frantically behind in AI and OpenAI was going to clean their clock. And, here we are. And that narrative seems to have just twisted on its head here. I still think it's still so early in this game that it's very hard to declare, where the ultimate winners are going to be. I mean, I think that, I talked to a lot of tech executives there that are on the front lines of AI, and they are just sort of bewildered by how this stuff is going to shake out themselves, and they're in this market every day.
Well, to me, this really goes to the question of how do you broaden out, right? What does it mean to diversify? Everyone who's come on this show to end the year has said that diversification is the key for next year. We've seen that in the precious metals trade, although it's arguable that that's not exactly diversification, particularly like when it comes to silver. How much do you see equal weight as being true diversification in this type of backdrop?
Well, really since last January, I started pushing this narrative that, as much as I love the big tech story as a core part of the portfolio, if you want to rotate and diversify, not to go into U.S. cyclicals and values. Now, obviously, there's a lot of specific sectors and specific stocks that have done incredibly well this year in the United States. But thematically, at the index level, what I'd advocated for was a rotation into European equities, which were sort of the ugly ducklings for so long, and in some respects they still are. But I think where I am right now is that, look, we've got the SX5E, I call it the SPX for the European continent. That has outperformed most every U.S. index in local terms, almost caught up with the Max 7 index. And on a currency adjusted basis, it's blown away most every U.S. major equity index. So looking forwards into 2026, where I'm at right now is I think that's going to happen. It's a very different set of dynamics. So I think, look, if the Germans really are going to start committing to this stimulus, and I think that's happening, it's hard to tell, but that is sort of a massive and a very different type of force than, say, the AI force, right? When you're talking about this pretty significant economy really pushing stimulus to a place that it's never been. They have the fiscal space to do it, unlike many other sovereign nations in the developed world. Right. And that will be really resonate there. Meanwhile, I think for the U.S. cyclical and value trade, well, there's still a lot of, I think, sentiment tied to that. So if you are concerned about the tech, I don't want to use the word bubble, but the tech theme, the dominance of tech theme, if you're sort of worried about that kind of not really working next year, to me, I think I sort of see Europe as a pretty good place, with a caveat that the rally this year has been driven largely by PE expansion, and the relative to PEs from Europe to, say, their U.S. counterparts are in a less compelling place than they were 12 months ago.
Stay with us. More Bloomberg surveillance coming up after this.
Investors are waiting the last read on employment in 2025. Jobless claims due at 8:30 a.m. Eastern for the holiday-shortened week. Michael Reid of RBC Capital Markets writing, "We maintain our view that tariffs will weigh on the labor market and put upward pressure on inflation, reinforcing that the U.S. economy is experiencing stagflation light." Michael joins us now in the flesh in New York. Thank you so much for being here on this New Year's Eve. I'm just wondering, from your perspective, stagflation light, what does that mean, and why do you see that taking hold in 2026?
Sure, and thanks for having me. So what we are expecting is generally below trend growth. That means below 2%, and inflation that remains uncomfortably high, really in that core space. So when you think about some of the dynamics, and it's not just tariffs, I should add, we just think it's going to be really hard to get back to 2%, even if you take tariffs off the table.
Does it seem like Fed officials really care? I mean, based on the meeting minutes, there was a priority on the labor market, not necessarily inflation.
Yeah, I think they do care. And what's really interesting is if you look at what they've said, especially in the last meeting, you include the fact that they view tariffs as being transitory, yet they're starting to take that cautious approach. They think they've gotten to a place that is much more closer to neutral. So they're concerned about the inflationary pressure, not just from tariffs, but coming from other places. And we think that's showing up in the services space in particular as it relates to labor supply.
So where exactly are you seeing this inflationary pressure? I can hear Neil Dutta in my head saying, look at housing. You're not seeing any inflationary pressure there. In fact, the housing data yesterday, we did get some signs that maybe it's picking up, but otherwise you've seen pretty much flat home prices across the country. I mean, at what point do you see some sort of inflationary pressure that could be sticky?
We see it in the wage space. And, when you think about some of the dynamics that we're seeing in terms of supply, we have immigration that's falling. We have retirements that we think continue to accelerate. At the same time, your demand for labor, while slowing, still hanging in there. So what that means is you're going to have a situation where the need for workers is still there. It's just showing up as replacement demand. So payrolls aren't going to look great by any means, but we are going to expect an environment where the unemployment rate remains low, where we think it plateaus around 4.5% for most of this year. And that just means you're going to have an environment where wage pressures stay elevated.
Yeah, well, so this is definitely the truth when it comes to healthcare. We've seen the bulk of hiring so far this year in healthcare. We're getting older. We still need to be taken care of. This does, though, raise a question about other sectors and what that means about the strength of the labor market. I mean, how durable is some of the strength that we've seen if it is concentrated in a completely recession-proof area like healthcare?
I mean, healthcare is a big one. So again, going back to this demographic story, you think about the sheer size of the population that's now over 65. You have about just under 40 million people in the workforce right now who are 55 plus. So they're approaching that retirement age. That's who we're really focused on. Those are the folks who are going to continue to use healthcare services across the board. So that's a sector that we expect both will continue to hire at a very healthy clip. 50 to 60,000 jobs per month over the next 5 years seems very reasonable to us. And in addition, you do have that price pressure. So when you think about some of the factors impacting prices in terms of tariffs, but as well as supply chains, that's going to continue to put upward pressure on services. So for healthcare, which is a very service-intensive type of sector, there's very little relief that we expect to see there.
There's a theory that the Fed is trying to run the economy hot to keep people employed as we get this structural shift with artificial intelligence, that as people become less necessary, you want to keep as many people as possible employed before we get to whatever that next future is. How much credence do you see in that? Do you think that that is wise for them to take that approach, given some of the cannibalization from human jobs?
I mean, look, their dual mandate is low prices and stable employment. So I think that aligns to what they're trying to do in terms of the mandate. Now, the outcomes for AI are still very early. Could we see a productivity boost? Absolutely. We expect that. Do we expect to see it in 2026? Not so much. But when you think about some of the dynamics that are going on right now over the next 4 to 5 years, when you account for that retirement boom that we continue to see, and the slowdown in immigration, you're going to need more workers. And if you don't have it coming from the outside, that immigration story, AI is going to have a very important role to play there to help supplement the falling labor supply. So that could help offset some of those inflationary pressures coming in the wage space.
Just in a shorter term time phrase, so we are going to get some real data in January that people think will be some cleaner data points to look at when the Fed meets on January 28th. What are you expecting when it comes to both CPI and, of course, the jobs report for the month of December?
So we're going to get a lot of mixed signals here, again, even in December, Q1. For the jobs report, like the Fed, we expect that the number will be look okay at face value, but you have to subtract out the benchmark revisions that are going to come from QCW. So already you have to take out 50 to 70,000 jobs per month based on that revision. So that's a big part of, I think, how the Fed is thinking about this, especially as it relates to that break-even pace of employment. That's why we've seen that unemployment rate rise despite rather healthy job gains from the payroll report. In terms of CPI, for December, we think we continue to see kind of a modest slowdown in terms of the pace, but it's really Q1 that's our concern. We've seen these seasonal quirks, notably in January, and we think that could be more pronounced as tariff pressure starts to add up.
Stay with us. More Bloomberg surveillance coming up after this.
Enhanced Affordable Care Act subsidies are set to expire tonight, sending premiums skyrocketing and impacting coverage for millions of Americans. Congress failing to find a resolution before the deadline. Joining us now is George Pollack of Signum Global. Can you just give us a sense, and great to see you, George, stepping back, how much of a focus this is for Republicans to keep some sort of healthcare solution? How much it is a popular thing for them to do heading into the midterm elections?
Well, the biggest issue for Republicans is healthcare is the one issue where Democrats poll better than Republicans. This is the issue where Democrats can really go on offense and say, we have the better ideas, or at least the more popular ideas. And going into a midterm election, that's already going to be a challenge when they've had the trifecta in D.C., allowing these subsidies to expire and exposing people to doubling of healthcare premiums is just not sustainable, especially if they want to keep the House.
We were talking at the end of last year, or the beginning of this year, about cutting the budget deficit and about cutting expenses. DOGE was a big effort. Now there is a question of how much of those cuts are going to basically come back onto the balance sheet, whether it's IEPA or whether it's some of these subsidies that get passed over. I'm just wondering, from your perspective, how much of a focus cutting the budget deficit still is in Washington, D.C.?
Look, I think it's a great line. I think when you're the party out of power, it's something you discuss, and you've seen moderate Democrats talk about it, and you see most Republicans talk about it. But the reality is, when they passed a one big beautiful bill, yes, that made tax cuts and the tax system permanent and gave businesses and Americans a idea of permanence, but it also cost billions, and it cost a significant amount of money and added to the deficit. It's a great campaign line, but unless there's no real appetite for embracing entitlement reform or anything like that, because it really is the third rail of U.S. politics.
How do you see 2026 being different politically than 2025, given the fact that the midterm elections are coming up and what happened in the midterm elections that we just saw?
I think what you're really going to see is these moderate Republicans who voted for things like the one big beautiful bill, who have defended the president, who are facing a very tough reelect, and with Democrats getting some pretty strong recruits in moderate districts, they're going to really try to separate themselves from the administration, and they're going to really try to stake out themselves as independent or focus-oriented members of Congress who just want to do what's best for America. And I think with Speaker Johnson having a very narrow majority, that's going to be something that he struggles to navigate, especially if he wants to do a second reconciliation bill.
George, there's something that not a lot of people are talking about, but is coming up increasingly on talk shows as well as just in op-ed pages across the country, across the world, how much of a focus there's going to be on artificial intelligence and either regulating it or providing some sort of safety net should there be some sort of mass job loss in the wake of a real adoption that does mean that certain humans are not needed anymore. How much of a discussion is there in Washington, D.C. about this as we head into 2026?
I think what you're going to see is the administration has fully embraced AI as the next great thing for the U.S. economy. And what you're going to see is the likes of both Republicans, so like Governor Ron DeSantis or Governor Spencer Cox, and you're going to see Democrats as well campaign against the administration's whole hog embrace. You've already seen Senator Bernie Sanders talk about suspending data center construction. I think what I put it a parallel to is when they were negotiating the original NAFTA and that trade disruption and the job disruption. I think Democrats are going to say, you're disrupting American jobs. You're threatening social stability, and you're increasing costs in things like energy. And they're going to use it as a huge attack line for the president, especially because Americans are pretty divided. I think there was a recent poll out that only by 5% are they really positive about AI. And that's really people who haven't yet learned all the details. And I think as Democrats hit the administration and the likes of David Sachs, I think that's going to be a very potent issue for Democrats in particular in 2026.
You mentioned Senator Bernie Sanders of Vermont. He is going to be at the inauguration of Zoran Mamdani, I believe, tonight, along with AOC, along with a host of other progressive Democrats. I just wonder what this really signifies for the Democratic Party in 2026, not necessarily Zoran Mamdani's inauguration, but just is this going to be the mainstream of the Democratic Party heading into the next presidential election season?
Look, I think that's a fantastic question. If you're a tri-state Democrat like Laura Gillen or Tom Suozzi, you're not happy about this because you're going to have to run against Mamdani and you're going to have to deal with the after effects of Mamdani's policies. But I think in reality, this midterm election is going to be a referendum on the president, a referendum on Republicans. And when the Democratic Party has the likes of Marie Gluesenkamp-Perez in Washington, Jake Angelos in Massachusetts, and formerly Jared Golden in Maine, it's really just going to be, Republicans will try to make it circa Nancy Pelosi 2006, 2008, but it's really not going to fly when Americans are more concerned about increasing health premiums, increasing energy costs, and the potential threat of AI.
Stay with us. More Bloomberg surveillance coming up. after this.
And I just learned that Matt Miller is also wearing a kilt because he is celebrating Hogmanay, which is the Scottish New Year. That is what we learned from Lizzie Burden over in London. Thank you for that. I'm glad to see that.
It's not true. It's not true.
You're not
I
wearing a
wish.
kilt?
I wish.
Okay, well, maybe next year, if they get another double-digit return, Matthew Miller will show up in a kilt. Barbara Doran is not wearing a kilt of BD8 Capital. She wrote, the Fed could be stingy on rate cuts unless labor takes a big dive. Barbara joins us now for more. Barbara, thank you so much for being here. Really appreciate it. On this New Year's Eve, a real question about the Fed and how much they can cut, given the dual mandate that they have of a labor market that they seem to be prioritizing right now.
Yeah, they definitely are, because the labor numbers have been soft. You saw that in the ADP number a few weeks ago, and of course jobs. But what we're not seeing is any really follow through on jobless claims. They are still not signaling, any danger there, and that obviously is a leading indicator. But I think that's where the emphasis is, because inflation seems to have stabilized. I think somewhere around here, 2.9. I think it could creep up a little bit higher, because even though the tariff impact has not been as severe as everybody expected, including myself, it's still feeding through now that there seems to be some stability in the outlook, for tariffs. So I think you could see it inch a little higher, but you're certainly not going to see it as it happened at post-COVID and things were opening up. So I think they are right to focus on labor and what that means. And right now we know what's happening in terms of lower immigration, baby boomers retiring. But it looks in balance. So you could see lower job creation, but that's because the demand will be lower. But that's the key thing. And the economic data has been a little bit behind. And we know there's problems with the recent CPI number. So I think it continues. The Fed is still going to be data dependent, but I don't see them cutting in the next month or so, because they need to see really if the trend in labor is going to continue to gradually go down or if it's going to be much stronger.
What do you expect there? Because we've had incredible growth, right? 4% essentially in Q3. We're expecting, above trend growth in Q4 as well, or at least at 3%.
Right.
And it's not like the labor pool is getting any bigger. We don't have any immigration to speak of. Demographics are going the wrong way. So do you expect unemployment to rise in 2026?
It could go up a tad more, but no, I don't see why it would go up. People are still spending, and obviously we know that's a major driver, 3/4 of the economy. And certainly some of the expectations for holiday spending is 4 to 5%. And some of the recent data, consumers are spending. And I think a big part of that is still this 40 to 50 trillion in wealth, trillion in wealth that's been created since 2019. That's out there. And people are still employed. Wages are not going up as fast, but they're still there. And that 4.3%, which we know was a percentage point higher for the third quarter GDP, is really interesting, because that means the 1.9% that the Fed is estimating for next year could be low. And that obviously is a question then, where do you invest? And that could be more cyclical rotation. In financial should continue to be strong. Certain industrials really tied to data center build out and on reshoring, all that sort of thing. So that GDP number is very interesting, and I think that strength could continue.
Well, and earnings continue to look strong as well. Forecasts are for double-digit earnings gains again in 2026. Do we finally get the broadening out? Is it, a substantial broadening out of the rest of the S&P rather than just these mega cap tech stocks?
Yeah, and I think that's the question of the moment. I think part of what we're seeing, why it's been soft this last few days, we had the market making new highs. So the classic Santa rally, which is the last 5 days, doesn't seem to be happening. But I think that's because, there's a lot of tax loss selling, people trying to figure out where to rotate into, because I think the strength will be higher. And the estimates for next year are 12 to 15% in earnings, doing bottoms up, measuring. And so that bodes very well. We've been seeing this quarterly increase. So what I think it does mean is this broadening out. I think you continue to have the so-called Mag 7 be strong, and you've seen only 2 have outperformed this year, but you'll continue to see profit taking and then moments where they continue, and they will move higher. These are, compounders. You look at NVIDIA, for instance, 26 times next year's earnings, and those earnings will continue to come up. So I think you stay in the Mag 7. That's going to be core, and obviously given the percentage of their, it's 30% of the market cap of the S&P, 40+% of profits, you stay there, but you should see financials, industrials. I don't think small cap continues to perform. I think that was a trade, and part of that's because interest rates, right now I see maybe one more cut. The Fed's signaling 2. too, but I don't see it. It's going to be very dependent.
So we were speaking earlier with Michael Purves about some of the transactions that we've seen to end the year, whether it's NVIDIA going after Grok, whether it's NVIDIA's transaction with an Israeli AI company this morning, whether it's something that we saw with Meta having to do with a Singapore-based AI company. And he was saying this kind of resembles 1999, 2000, where they're just having this sort of FOMO and the C-suite try to get as much as they possibly can. Sounds like you see it a little differently. Is that right?
I do. I mean, there is always the potential for overbuilding. Everybody sees the same opportunity. We know this happens in a capitalist society, that always happens. But I think we're far away from it at the moment. And 2019 is not, I think, a good analogy because so many of those companies did not have earnings. It was just like, invest in, it was wild. It was a free-for-all. And so here it's very different. I mean, the companies, the hyperscalers, et cetera, they have huge cash flow. And it's only Oracle that is really dipping deep into the debt side of things. The others are, are using their free cash flow. So I think it's very different. So at some point, yes, it will end. But I don't think we have to worry about that this year.
You were talking about diversification and how it's not going to come from small caps, how it's probably not going to come from the other 493 necessarily. Is it going to come from Europe? Is it going to come from overseas? That's what we've seen this year.
Right. I mean, you've seen outperformance in the emerging markets, certain emerging markets. Certainly things seem to be stabilizing with China in terms of the rhetoric between us and them, which is a good thing. You've also had with the dollar down 10%. The question is, does it continue to go down or is it stable here? And of course, that is tied to interest rates and how much the Fed will cut or not cut. So I think you probably still have an EEM, the emerging markets, earnings were better, it's more stable. So I think you've got opportunities there. And certainly we know the European defense build out and fiscal spending is not over in 6 months. So you probably do have more upside. So diversification, you can look abroad.
I have a sports question, and maybe Lisa can weigh in too, because she's got kids in this age range. I was having a discussion with people last night who have teenagers that aren't playing football, and I'll get to why in a second.
It's okay. Carry on.
And where I live in Edgemont and Scarsdale, there are years where we can't field a team anymore, just because parents don't want to risk the brain injuries. And I noticed looking at your CV that you're on the Lacrosse Association and the Field Hockey Association. I wonder if those sports are any safer. Are those sports? I mean, I know they're picking up massive amounts of popularity.
Yeah.
Do you think we're going to see the same trend in football happen there, or is it different?
These are always interesting questions. Lacrosse, there's men's and women's that are very different. Women aren't allowed to hit each other. Men can, but they've
not
got
allowed
a lot of
to,
equipment.
but I imagine they still do.
Yeah. I have a plate in this hand as a result of that. But, it does. And also field hockey, you've got mouth guards, you've got this and that. And there is real awareness and consciousness, certainly in high school, area. But so there's awareness, but I don't think it rises to the level of football, which has such well-documented serious injuries.
So maybe lacrosse and field hockey take market share. I mean,
it would be nice, no, but I think it's two different things. Being a field hockey.
BD8 Capital, indeed. And I will just say thank you so much.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.